afternoon, everyone. I'm Stacey Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'll be hosting today's webinar. I'd like to start out by thanking you for joining us today. We certainly appreciate your time, and we hope that you find today's Lunch and Learn informative. Our topic today is New Year, New Plan, and we have industry experts on hand to share a few tips on what may need to be assessed from a total wealth management standpoint as we kick off 2022. We're going to be starting off with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and he's going to provide some information from a financial planning aspect, and then he'll be followed by Susanne Wickham Cook, also with Wickham Financial and Insurance Services, and she's going to talk about some things to consider from an insurance standpoint. Attorney Stan Faulkner will provide some food for thought from a legal perspective, and John Dickson, with a CPA with Henssler CPAs and Advisors, will discuss some accounting considerations. Throughout today's session, if you have any questions for any of our presenters, please type them into the Q&A section of the chat box so that we can address those during the question and answer section at the end of the webinar. And as always, you'll see Graham's calendar pop up from time to time during the presentation. If you'd like to schedule time to talk to him or any of our team members, please click on the calendar when it pops up and tell us when the best time that works best for you. And since we have a lot to cover today, let's go ahead and get started. Graham?
Hey, thank you, Stacey. And matter of fact, I might just give you the clue to kind of change the slides since we have so many people on the call. But first off, I really want to, take the time and just thank you for being on. I think one of the calls that I love to have, and that's having experts in all the different areas of wealth management to really talk about what you need to know, what's important, kind of what's hitting home, not just this year, but things that we just need to be mindful of in general. My time today, I'm going to spend, Stacey, if you would advance that. My time, I'm going to spend a little bit talking about maybe the elephant in the room, if you might. I'm going to be talking about, the markets. Anyone that's invested in the markets now, if it's stocks or bonds or whatnot, I don't probably have to tell you, it's been pretty dramatic of late. Many of the indices from the NASDAQ, the S&P, the Dow Jones Industrial have already entered, if not exceeded corrections. Correction would be about a 10% drop. We might even have bear markets of up to around 20%. Stacey, I'll go ahead and advance if I need to.
Okay.
So when we're in these periods of evaluation, and I think we're really in a period of evaluation from a risk off standpoint, the biggest thing we can always tell our clients is just take your emotions, check it out the door. Remember, you have a plan in place. Follow the plan. Make sure you own great quality. I'll reiterate this here in a minute. But one interesting thing I did want to bring up is an analyst we follow from the Jim Paulson group, Jim Paulson from the Luthol group. And he really brought out an interesting little article talking about a low confidence correction. And we are in a correction. Again, a correction is 10%. A bear market is when the indices fall more than 20% or investment in general. And basically, he's pointing out some things that I think are worth consideration. It's no guarantee that the future will be emblematic of the past, but I think it does have some sort of rhymes or some rhythm to it. So January levels of consumer confidence. So where we're looking at where the consumer is, are they very confident on where we're at? Or they're a little more pessimistic? We're looking at a pretty low confidence level of about 68.8. Jim pointed out that's lower than 90% of the time since 1952. And basically, long story short, we've never entered a bear market when confidence was so low. Since 1952, the U.S. stock market has suffered 25 corrections and 10 bear markets. One thing off of Jim's comments that I'd like to make is you have to embrace pullbacks. You have to embrace corrections. That is a part of investing. And if you're a client of ours, or if you're a viewer to our webinars or watch our weekly wrap-up, so on and so forth, you've heard us comment so many times, get prepared for more volatility this year and going forward. Maybe a little more muted returns and up the quality in your investments. That is in bonds, that is in stocks, that is in general. Keep extra cash on the sidelines. If we think about the bear market has never occurred when confidence level was so low. And he brings up an interesting little chart talking about the bear markets in association with consumer confidence. We go ahead and look at, and I don't want to run over my time, kind of our general thoughts. Our general thoughts, as I mentioned before, is balance. Have a balance in your approach. It's not all value, all cyclical. It's not all growth and speculation. It has to be a balance. It has to be a part of a plan that you create. It's not just a plan with your investments, but it's a financial plan that you need to have in place. And up the quality. It's great to reach for returns, but I think a lot of consumers have reached too far in the past since it seems so easy. Up the quality, dividends, good cash flows, good sales, good profit margins, maybe a little boring is not bad in this market. And we tend to focus on what we call GARP, growth at a reasonable price for companies, not growth at any price. So if you focus on those four, I think that goes a long ways to manage through this volatility, this drama that we have in the market. Stacey?
Thanks, Graham. And now we're going to move on to Susanne Wickham Cook. And she's an agent here with us at Wickham Financial Insurance Services. And she's going to talk to us a little bit about insurance. Suzanne?
Hi, thank you, Stacey. Yes, I just wanted to go over a few tips today on how, if you see some increase in your premiums this year, these are some just little tips to maybe help bring down those rising costs. When it comes to your personal lines insurance, of course, if you can try to bundle your home and auto, motorcycle, boat, whatever it may be, umbrella with the same company, that is a good way to help get a multi-policy discount. Also, be sure that you review your coverages and review your vehicles on the policies, review the drivers in the household. If anybody's moved out, just be sure everything is up to date. If you do have a young driver in the household, see if you can get a good student discount, or if they have a driver training certificate to get that discount. Any driver in the household can take defensive driving. A lot of companies will accept that as providing a discount on your policy. There's also the telematics program that's available if you were to sign up for paperless, so everything would come to your email instead of regular paper mail. And if you could pay in full, companies usually will give you a discount if you could pay in full or choose an EFT, automatic draft option. Same goes with the homeowner's insurance. Again, if you can, the more things you can bundle together, more of a discount you may see. I would recommend reviewing your dwelling coverages, reviewing your deductible. If you can increase your deductible, that would definitely help lower your premium. If you could get an alarm system in your home, fire, burglar, and updates, especially if you have an older home. A lot of companies will provide discounts if you have a roof replacement or plumbing or electrical or HVAC updates. All of those the insurance company does like to see and will provide discounts. On the other side, for commercial insurance, again, if you can put all your lines of coverage with the same company, that is helpful to get multi-policy discounts. Another way would be if you're using a third-party financing. If you could put your policies on one finance agreement together, that's going to save you in finance charges. If not, that's understandable. Just see if you can do a paid in full option, or again, the EFT. Now, on general liability as well as workers' comp, I would look at your coverages. Be sure your coverages are in line with what you need for your business. If you have an automobile that you're using for business, you want to be sure you don't have that covered on a personal auto policy. You would probably need to get a business auto policy. Be sure that your business is covering you correctly for the protection. And review your subcontractor costs. Be sure those are in line. Review your gross receipts, because things have been crazy these last couple of years. So just be sure that your policies, a lot of them are rated on gross receipts and your payrolls for employees. And again, like I said, subcontractor costs. I would just be sure that you review everything as your renewals come up. Is a good time to do that. It's a good time to remind yourself. I hope that information was helpful for you today. Thank you.
Thanks so much, Suzanne. And as always, if anybody has any questions about any of those points that Suzanne brought up or any others, feel free to call us, and our team members will be happy to walk you through it. I'd like to move on now to Stan Faulkner, and he's going to talk to us about things from a legal perspective. Stan?
Thanks. Thanks for having me on. I appreciate it. And so if people don't fully know what we do, we're an estate planning and probate attorney law firm with business and real estate mixed in. One thing I want to bring up to folks is this is, we're towards the end of January. One of the most common things I see in my practice from an estate planning perspective is that, and this also sort of dovetails in the family law to some extent, is that lots of things happen over the course of a year. And in the past year, you may have had circumstances change in your family, circumstances change in your life, whether it's a job, maybe you got married, maybe you have a kid that's now graduated from high school, or a loved one passed away. So there's all these circumstances that come in during the course of a year. And what a lot of people end up doing is keeping the status quo and saying, I'm going to address it next year, right? Or I'm going to wait till the holidays are past us and then I'm going to do things. And so we see that more common than not. And believe it or not, the statistics bear this out, particularly with if you have elderly parents or people that are sick, is that their spirit will allow them to hang on until Christmas, right? Until they see their family. And then a lot of times we see deaths in the family occur in January, late December, things like that. All of those are impactful, obviously emotionally, but also impactful from an estate planning side and from a financial planning side. So one thing to do at the beginning of the year is to sort of take a quick jog and look back at what occurred in the past 12 months. Did my oldest or my youngest child just graduate high school and is now going to college? Are they in state or out of state? If they're out of state, you probably need to think about estate planning from their perspective and what documents you need to protect them when they're in another state, i.e. a healthcare directive. An 18-year-old is an adult in the eyes of the healthcare system, and the healthcare system may or may not talk to you if they're in an emergency in the hospital, right, about their care. And so you may need some document to help you with that. So we do a lot of that with college-age kids and kids going off. But also, if maybe now you're going through a divorce at the beginning of the year, and how does that impact your financial plan and estate plan? Maybe we need to be thinking about beneficiary changes on life insurance and other retirement accounts. And now maybe we need to remove people from an estate plan, whether it's a will or a trust. Or maybe I got married in the last few months, great occasion, and now I've got to update some documents again, right? Or we're having a baby soon in the next 6 months, right? And so that should also be an opportunity for us to consider what needs to be in place. So what we see at the end of the year and turning the year is always there's some things that occurred that have an impact on us. And everybody does this. We all tend to put things off until the new year. Well, now's the right time. We're starting to get geared up. We're all making plans. We're making goals about things we want to achieve and things we want to mark off the list. And this is an easy one to mark off. It's like just sit down and examine it. Maybe you don't need to do anything, or maybe you need to do a tweak that's very minor. Or maybe it's a complete overhaul, right? But now's the opportunity to do it so that we've put it off for a while. And now let's get it back in gear and fine tune so that it does what you want it to do or what you think you want it to do. And it's no better time than to sit down and have a consultation, just examine it, think about it, bounce some questions off, and see if there's something that can be put into place. So that's just a food for thought kind of thing, sort of as counsel. This is the type of advice I give to clients all the time when they call me about stuff at the beginning of the year. And so it's a good opportunity to make a new introduction and just see if there's anything that you need to do, or maybe you haven't done anything at all and now you're thinking it's time to do that. So it's now before you get too busy in the year and before you get into the first quarter, because then now we're in the weeds again, right? So now's the time to do it. Now's an opportunity to sit down and spend, a half an hour, 45 minutes with somebody and discuss it. Just food for thought from as we start the beginning of the year.
Thank you, Stan.
Mhm.
Appreciate that. Okay, now we're going to move forward to John Dickson, who will talk with us about some accounting tips. And John, I'll turn it over to you.
Thank you, Stacey. My name is John Dickson. I'm the majority owner and managing partner at Henssler CPAs and Advisors. Our firm assists clients with their tax and accounting needs. I could speak about taxes for about 8 hours, but to save you guys a lot of heartache, I'll go ahead and just spend 5 minutes on highlighting some tax tips that we just want to point out as we're closing out 2021 and moving towards 2022. There's no secret that the IRS and the Georgia Department of Revenue, like many others in the economy, are having staffing issues. So one thing that we inform our clients is we want to make sure that we don't have any filing discrepancies when we file our tax returns that could delay their refunds. So two things you want to look for as you prepare your documents for filing for 2021. You want the IRS notice 1444 or any bank statements showing your stimulus payments received during 2021. So that way you can report the correct amount of stimulus received during 2021. So, and then the other thing is the IRS letter 6419. And this is the document that shows the receipt of your advanced child tax credit payments. So we want to make sure that those two items are correctly reported in order to make sure your refund is issued in accurate timing. Two things that we point out to clients for those who don't itemize are cash contributions above the line. For 2020, there was a $300 deduction above the line for cash contributions. For 2021, you can actually deduct up to $600. So make sure that even if you don't itemize and you use the standard deduction, that you accumulate your cash contributions to be able to take that tax benefit for tax filing purposes. And then even though we're into 2022, there are some things that you can still do to help your 2021 taxes. If you qualify, you can still make deductible IRA contributions up till April 15th, as well as HSA contributions if you qualify. So please take the time to look at those and work with your financial advisor to see if those are two tax opportunities that you can take advantage of to help with your taxes. Couple other things, you want to track your refund status. There's numerous times clients file their tax returns and they get busy and throughout the year and they never go back to look and make sure the refund was actually issued. You can go to the IRS.gov website as well as the Georgia Tax Center website and actually put in your tax information to track your refund for the year. We also encourage clients to set up an actual login with the Georgia Tax Center, and you can actually review your status for each year. We've had clients that log in and actually find out that there's been a refund issued a couple of years ago that hadn't been refunded yet and hadn't hit their account, so they're able to claim that refund. Then for businesses, real quickly, for 2021 and 2022, you can deduct up to 100% of your business meals. So that's something that in the past it's been 50% limited, but because of COVID, the IRS is allowing 100% of business meals. So make sure you take advantage of those deductions as well. For Georgia is now, as most states are, allowing an entity level tax. So you can actually pay your taxes at the entity level. So this will allow you, if you have a business, instead of paying taxes at the individual level, where itemized deductions are limited to $10,000, you can actually make an election and pay the tax at the business level, therefore getting a tax deduction for your taxes paid for the business. So that's actually an effective rate of whatever your federal effective rate is, that's your return on your investment for that deduction. In the past, a couple of things that have gotten around that were the rural hospital credits and the Georgia Gold credits. The benefit of those has really been eliminated by the entity level tax. However, if you'd rather donate, pay the rural hospital or participate in the Georgia Gold scholarships, instead of paying Georgia Department of Revenue, you would be getting tax deduction for taxes paid to those programs as well. A couple of other quick tidbits for businesses you can take advantage of: hiring family members, paying family members. You can still run payroll now through the end of the month, so that's something you could do technically until the 31st. Also, number one thing, well, one of the top things we hear from business owners is they don't want to take the home office deduction. They feel like it's going to raise red flags. There's nothing wrong with taking the home office deduction. If you have a home office, you should be taking advantage of that deduction. And then you also want to work with your financial advisors to set up any potential retirement accounts and maximize the tax benefit from participating in those retirement accounts. So those are just some quick, easy tips for tax as we close out 2021 and move forward to 2022. And if anyone has any questions, happy to answer those. Thank you.
Okay, thanks so much, John. Appreciate that. And it looks like we do have a couple of questions coming in. So I'm going to start out with, I think this is for Graham. Graham, how long do you think the market's going to be down?
Someone stole my crystal ball, Stacey. I don't know. Well, I mean, if history is any guide, and it's certainly not a guarantee of what will happen in the future, you know, you could be easily looking at peak to trough, you know, any 15 months, 24 months, within a month. It depends on the magnitude, the depth. I would personally think, and again, my opinion for whatever it's worth, if we are in a low confidence correction, as Jim stated, I would be more inclined that the market will not stay down as long, possibly over the next couple months, and we could still end the year higher on the indices. Let's say the S&P, potentially more than the NASDAQ. If that helps, we'll just have to wait and see. It's going to be the depth of this pullback. We've already seen 10 to 20% respectively. You know, usually it overshoots on the downside, but at the same time, it overshoots on the upside. Great question.
Okay. Great. Thank you. Hey, John, do you expect any delays in filing with the IRS this year?
Well, the IRS is actually open for electronic filing. Individuals opened Monday. So Monday you're able to file electronically. Commissioner Reddick has communicated that they do have issues and expect problems. Normally you could expect a refund within 2 weeks of filing in the past. I don't see potentially with all the issues going on with the IRS that occurring on a common consistency, but depending on your filing and how complicated your return is, I would expect a refund within 2 to 4 weeks, but I don't expect any extensions on the filing deadline. In the past, it's been extended to July 15th, and then last year was May, but from what I understand, they're planning on keeping the April 15th deadline this year.
All right.
Hey, John, I've noticed that the IRS is pretty quick to cash our checks, not to give us money back.
Well, they've spent it before they get it. So yeah, they're not quick at issuing the refunds. And actually, technically, I guess the deadline this year is the 18th because the 15th. Yeah, the 15th is a Friday. So yeah, it's April 15th. But yeah, they issue they're a little slower, but they do pay refunds though. So if you have refunds they pay interest on the refunds. So if you had a refund that hasn't been received yet, they'll pay it from the deadline, so April 15th. So I did have clients who actually, made more money with the government holding their money than it would have had they got the refund and deposited in the bank. So always a silver lining.
That is. Thank you.
Susanne, I have a question for you. Is cyber insurance something that folks need to consider?
Oh, yes, definitely. I think we're definitely seeing a lot more cyber activity. Everybody's getting more social media, more online accounting, more online medical. You set everything up online these days. So cyber is definitely getting more important for people to have. It's also increasing in price as well, but it would definitely be something to look into.
Okay, thank you. And Stan, someone's asking about trusts. Are trusts something that everyone needs?
Not necessarily. I think everyone should probably explore the conversation and see if it applies to their situation, but it may not apply, right? It just depends on does not necessarily depend on the number of assets you have, although that's a factor. It really depends on what a person is trying to accomplish and what they want to do with their assets in the future. So while it may not be necessary for you as an individual based on what you want to do, it's worth the exploration just to see and to educate yourself about the trust. Because when people say they're interested in a trust, my natural thought is, okay, what kind? Because there's dozens of them, right, that you can do, and they can be simple or they can be complex. So it's worth a conversation to explore. It may not fit what somebody's trying to do, though.
Okay, thank you. Graham, I believe this question is for you. With everything being sort of volatile in the market, should I just hold on to extra cash?
I'm going to answer that question, but I want to add a question over, or ask Stan a question real quick.
Okay.
A common question that we get with our clients, Stan, I know we've had conversations, is I have a will, do I need a trust too? Or is a trust better than the will? Could you add some flavor on that?
Yeah, generally speaking, a trust is better than a will because it's easier to operate long-term after you've passed away. It allows for a more efficient transfer of wealth in the future. In that regard, it's better. In some regards, it's not better. It may be too expensive for you, or maybe overkill in what you're trying to accomplish. If you have a trust, you still need a will. If you have a will, you may or may not need a trust, depending on what you want to do. But I personally think a trust is a better, more efficient transfer of assets in the future than a will is, because you got to deal with court with a will. And nowadays with COVID, courts barely function. They're barely open. They take a really long time. What used to take 30 days in court now takes 90. And because they got half staff and they're working remotely and they don't have the files at home, whatever, right? It's a mess. And it used to be really short and sweet, and now it's not at all. So add that to the factors of why a trust is better. You just don't have to go to court.
Okay, thank you so much.
Mm-hmm.
Graham,
Yeah.
What about the extra cash?
Yeah, I think you do, right? And cash is not
In a coffee can?
I'm sorry?
You need it in a coffee can in the backyard?
Yeah, just dig that hole. Just not as deep right now, right? I don't think it needs to be under the mattress, but there is a place to have a little extra cash. Our biggest advice on that is don't rely on good markets for the stock and bond market to provide that extra income you might need. We want you to have discretionary emergency in the standpoint from emergency funds. I extended all the way out to minimally 3 months up to 1 year of your to cover your basic expenses, all the way to the standpoint of 6 months to 1 year for any income you're taking from your investment accounts that you need to live off of, right? So the last thing we want to do is get into an environment of negative sequence of returns where you're pulling from your investments in a down market that now is not there to have an opportunity to appreciate back when the markets do rebound. And they will one day, right? We just don't know exactly when. So I think a good financial plan can address that, cash flow analysis. One thing I'll add to this, Stacey, and I don't want to overstep our bounds here with time, but I think it's really important to think about your distribution rate, right? So how much am I taking out of my investments, my pots, if I might, to use for my retirement or whatever it might be, a boat, a house, college, whatever it might be. And that's something you need to think about. The old rule used to be around 5%. Well, yeah, I mean, if you're making 8%, you take 5%, you still have 3% return before taxes and addressing inflation. But I think we got to be a bit more mindful of maybe the distribution rate needs to be below that. I think more of a guarantee with solid stock exposure, meaning overweighting in stocks and bonds, might be around 2.5% to 3%. That might be conservative. So I'm sorry for some of my peers out there, but I'd rather be more conservative. You got money left over at the end of the day, then you come up short. So I think it's important to look at your distribution rate and then make sure you got cash set aside for those emergencies and also for your income needs. All right.
Okay. Well, thank you so much to all of our presenters and to all our viewers for joining us today. I think there's definitely been something for everybody in today's presentation. And don't forget to follow us on social media, such as Facebook and LinkedIn, and check out our website to view our weekly wrap-ups that we post every week and recommended articles and other valuable information. Hope everyone has a great afternoon, and we will be looking forward to seeing you again next month. So thank you so much.
Take care.